Hey Legacy Traders, it's Tim Key with Option Legacy, helping you build a legacy through trading. First off, guys, you thought this was a black shirt? Nope. It's a purple wine shirt with some baby stuff on it. Yeah, I've got a 1-year-old and I'm not ashamed. But hey guys, I want to take this video and share with you guys about a bull put spread. What is a bull put spread? When do we put it on? How do we get in? How do we get out? Things like that. So let's go ahead and transition over into that slide. Boom, bull put credit spread. So when to enter? We're going to put on a bull put spread is entered when the option trader, that's us, thinks the underlying stock will rise, will go bullishly, moderately in the next short term, excuse me. So when we think the stock is going to go bullish, we're going to put on a bull put spread. So how do you set it up? You put on a bull put spread can be set up by selling one out the money, OTM, out the money option, while buying one further out the money option of the same stock at the same expiration date. So the example of that is you sell one out the money option and then you buy one further out the money option. That's selling. So you see at the bottom of your screen it says sell one OTM option. That selling of the out the money option needs to bring in or be of greater value than the option that we're going to buy. And when we buy or go long in a further out the money option, it should be of less value than the one that we sell. That creates the credit to our account. So what's the risk? The maximum loss on this strategy is defined. It's absolutely defined, so by the time you open it to the time you exit it, you know exactly what your most or max loss. It's the difference between the strikes minus the credit that you received. So max loss in this trade happens when the stock closes, the credit closes below the credit amount of your short strike. The max gain on this trade happens when the stock closes above the price of your short strike. So once again, the max loss happens on this trade whenever the stock of the underlying stock closes below your short strike and the credit that you received. So we're going to give you an example of that in the coming slides here. So what's the break-even point? The break-even point in this trade of this trade is the short strike minus the credit you receive. And you might be thinking, what does that mean? Well, here's an example. So ABC stock is trading at $50. We think or estimate that the ABC stock is going to continue to move upward, $50 and higher. So what we can do is put on a bull put spread by selling a 47 put, and we take in a $200 credit for that. Then we buy, to hedge ourselves, a long 42 put, and we spend $50 to do that. So the net credit of that is $150, or $1.50 times 100 per option contract. So the max loss on this is the strike difference minus the credit received. So if you'll look, it says we sell 47 and buy 42. That's a $5 wide strike. And to do that, we take in a net credit of $150. So $5 minus $1.50 equals $350, or $3.50 times 100 per contract. One contract controls 100. The max profit that we can receive on this is the credit that we receive, in this case the net credit of $1.50 times 100, because one contract controls 100 shares, so $1.50 times 100 equals $150. But let me take you into a example here inside of the SPY. So let's say it's been boom, 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 boom. It's been going up, came down, went up, came down, went up, came down, and it's right here. And for some odd reason, because of indicators, because of technical analysis, because of past performance, we believe that this stock is going to increase in value. So what we can do is sell a put down here at the 255 and then buy a put at the 250. $5 wide strike, and we take in a $1.50 credit, or $150. So that means our max loss here is the short strike minus the $1.50, which let me make a little line here. So 255 minus the $1.50 is 253.50. Let's see if I can turn that to some neutral color. We're just going to turn it blue, and we're going to see if we can't make... it's fine. Yeah. So if it came all the way down and penetrated 255, which is a short strike, but we took in a $1.50 credit. So that means we can come down all the way down to 253.50 when we break even. If it comes all the way down to 253.50 and then busts up, so it penetrates our short strike minus the credit that we receive, and then it continues to move to the upside, which is our directional trade. This is a bull put spread. Bull is the directional trade. Then anytime that it expires above our short position, in this example is 255, or really our break even, which is 253.50, then we make a profit. Now, if it continues downward past our short strike minus the credit that we receive, then we begin to enter into a loss, and our max loss happens whenever it crosses our long position. In this example, it's a $250 strike. So our long position, if it came lower by the time of our expiration, we would enter into our max loss. So the goal of this trade is that by expiration, so whatever time you define, you can, options obviously have different expirations. We aim for 45 to 60 days worth of time. But let's say by this time, right here, is your expiration. To give an example, you need it to, the max profit is going to happen whenever it expires above your short strike. Some profit is going to happen if it expires between your short strike and minus the credit you receive. And max loss and max loss is going to happen between your credit you received and your long position. And your max loss will happen is if at expiration, which is represented by this line, it is down below this. So if we're putting on a bull put spread, we obviously need this thing to bounce upward, and our max profit will happen anytime the underlying stock is above the current short strike. So guys, check out this trade. Check out this checklist. I'm going to give it to you. It's in my legacy trading course. You can check it out by one of the links below or around, somewhere around there. You're going to be able to have access to enroll in the legacy trading course. I guarantee this, that you'll make 3 times the cost of the course, or I'll give you your money back. And if you don't want your money back, let me work with you until you do triple the cost of the course. So if you give me $1,000, I'm going to guarantee that I'll show you how to make $3,000. And if you don't, I'll work personally with you until you do. So if that sounds good to you, go ahead and check out one of the links below around and get this thing rolling. But let me show you this checklist that I give to my legacy traders. Here, bull put spread. So stock above the 20-day moving average, stock over the 50th percentile, stock over 1 million of volume, select the 30 to 60 days. We aim for 45 days. Select the short strike put to be 30 delta or less. The long put strike to be at $5 outside of your short strike. Both short and long to be out to have 100 or more open interest. Pulls in a credit of $1 or more, or 30% return on investment. I show you how to break that down in legacy trading course. Has a greater than 70% pop. Negotiate 1/3 bid and ask spread. Send order once order is filled. Set your good till canceled order. So guys, it's all the details for you that you need to be successful. So go ahead, reach out to me directly in Facebook, in the Facebook Legacy Traders group. Let me know what you think about this video, and I will see you on the inside.